All right, class, welcome. Today, we're going to pull back the curtain on a process that might seem pretty simple on the surface, but is actually packed with legal, financial, and strategic importance: how a company pays a dividend. Now, this is so much more than just a company sharing its profits. Think of it as a critical message to the market, a binding legal promise, and really a direct window into a company's financial health. For every one of you who's planning a career in business, really understanding this process is absolutely fundamental to reading between the lines of a financial report.
So this is the central question for today. How does that promise, that corporate IOU, turn into actual spendable cash in a shareholder's bank account? It's not magic, it's a carefully orchestrated process. And for those of you aiming for careers in accounting, finance, or even senior management, you have to know this mechanism inside and out. It's truly the language of corporate governance. So let's get started.
Okay, first things first, let's make sure we're all on the same page with a rock-solid definition. A dividend is a distribution of a company's earnings. That word is so important. This isn't just some random cash payout. It's a return of profit to the owners, and it comes directly from the company's accumulated profits, which, as we know from our accounting principles, sits in that all-important equity account, retained earnings. And crucially, this decision can only be made by the board of directors. They're the ones legally responsible for acting in the shareholders' best interests. And when they decide to issue a dividend, it sends a huge signal about their confidence in the company's future. The entire dividend journey unfolds across 3 critical dates. You've got the declaration date, the date of record, and finally, the payment date. Each of these milestones triggers very specific legal and accounting events. You can't understand the full picture without understanding what happens on each of these days. So let's break them down one by one. Our journey starts with the declaration date. This is the moment of commitment. It's the day the promise is made official. And in the world of accounting and corporate law, an official promise like this isn't just talk. It fundamentally changes the company's financial position from that moment forward. So picture this. The board of directors meets, they vote, and they pass a formal resolution. It might sound something like this. The board of directors hereby declares a cash dividend of 50 cents per common share payable on December 15th to all shareholders of record as of the close of business on November 30th. That sentence right there is now a legally binding contract. The company is on the hook. So what does this declaration actually do? Well, 3 massive things happen immediately. First, as I said, it creates a legal obligation. Shareholders could theoretically sue the company if it didn't pay. Second, and this is crucial for us accountants, a new liability pops up on the balance sheet. We call it dividends payable, and it's a current liability because it's due within the year. And third, it's a powerful signal to Wall Street. A steady dividend says, hey, we're stable, we're profitable. A surprise dividend increase can send a stock soaring, but a dividend cut? That can be a huge red flag, signaling that management is worried about the future. Okay, next up is the date of record. The promise has been made. Now, the company has to figure out exactly who to send the check to. Think of it like planning a party. The declaration date was sending out the main announcement. The date of record is when you finalize the guest list. So on this specific day, the company literally takes a snapshot of its shareholder list. If your name is on that list at the close of business, you get the dividend. Simple as that. But this brings up a really critical concept for anyone who's ever going to buy or sell a stock, the ex-dividend date. Now, because it takes a couple of days for a stock trade to settle, meaning for the official ownership to be transferred, the stock exchanges set an ex-dividend date, usually 1 business day before the record date. If you buy the stock on or after that ex-dividend date, you won't be on the official list in time, and the seller, the previous owner, gets to keep the dividend. This is a classic rookie mistake in trading, missing out on a dividend by just 1 day. Let's actually put ourselves in the shoes of a professional for a minute. Imagine you're a portfolio manager, right? You're managing millions, maybe billions for clients. You've decided a stock has run its course and it's time to sell. Before you even think about hitting that sell button, the first question that has to pop into your head is, wait, what's the date of record for the next dividend? Because if the ex-dividend date is tomorrow and you sell today, your client gets nothing. You just left money on the table. That one single date dictates your entire trading strategy around that time. It's a perfect example of how these seemingly small administrative details have huge financial consequences. And that brings us to the final stop on our journey, the payment date. This is it. This is the day the promise is fulfilled, the day the economic value finally moves from the company's bank account to the shareholders. The payment date is pretty much exactly what it sounds like. The company's transfer agent pushes the button, and the funds are dispersed to everyone who is on that guest list from the date of record. Now, back in the day, this meant literally printing and mailing thousands of paper checks. Today, of course, it's almost always a seamless electronic transfer into your brokerage account. And from our accounting perspective, this is the day we finally see the cash account on the balance sheet go down, as the company settles the liability it created way back on the declaration date. So when you lay it all out like this, you can really see the whole sequence. A promise is made on day one. About 3 weeks later, the list of recipients is finalized, and then, a few weeks after that, the payment goes out. And these gaps aren't random. The time between declaration and record allows the market to adjust and gives traders time to position themselves around that ex-dividend date. And the gap between the record date and the payment date, that's purely operational. It gives the finance department time to get all its ducks in a row and ensure the cash is ready to be transferred smoothly to potentially millions of different shareholders.
Okay, we've covered the what and the when. Now for the really fun part. For us, anyway, let's put on our accountant hats and look at exactly how this process gets recorded in the company's books. How does this affect the fundamental accounting equation? Assets equals liabilities plus equity. This is the language of business, and if you want to be fluent, you need to know this. Let's trace the double-entry bookkeeping here. It's a two-step dance. First, on the declaration date. The moment that promise is made, two things happen. We create a liability, so we credit the dividends payable account, which makes liabilities go up. Now, to keep the equation in balance, we need a corresponding debit. Where does it go? It goes to retained earnings. We debit retained earnings, which reduces our stockholders' equity. Why? Because we are literally earmarking a portion of those past profits for distribution. Now, notice what has not happened. Cash hasn't moved. Not a single penny has left the company. This is a huge common point of confusion. Okay, now let's fast forward to the payment date. Now we settle the debt. We get rid of the liability by debiting dividends payable, bringing it down to zero. And how do we pay for it? With cash. So we credit our cash account and our assets go down. See how it works? The balance sheet stays perfectly in balance through the entire process. So we've gone through a lot of mechanics, right? A lot of dates, debits, credits. You might be wondering, why do we need to know this in such detail? Because understanding this process is about so much more than a simple transaction. It gives you a sophisticated lens through which you can analyze a company's financial discipline, its cash management strategy, and its real commitment to its owners. So if you're going to take away just a few key lessons for your future careers, let it be these. First, precision in corporate finance is everything. These dates are not suggestions. They have real-world financial impacts that affect a stock's price and drive trading strategies. Second, this whole process is a report card on a company's discipline. A clean, predictable dividend process is the sign of a well-oiled machine. And finally, let's hammer this home one more time. Do not make that common mistake of ignoring the record date and the ex-dividend date when you're buying or selling a stock. It's an unforced error, a self-inflicted wound, and now you know exactly how to avoid it. So I'm going to leave you with a final thought, a little piece of analytical homework. We saw that the gap between the record date and the payment date is usually a few weeks, right? It's for administrative purposes. But what if you were analyzing a company and you noticed that gap was getting longer? Maybe it's 2 months or even 3. Knowing everything we've just discussed, what might that tell you? It could be a subtle but serious warning sign. It might suggest the company is having trouble with its cash flow. They made the legal promise back on the declaration date, but they might be stretching out the timeline because they need to scramble to make sure the actual cash is in the bank to make the payment. It could be an early indicator of liquidity problems. And that, right there, is why we study the details. Because in the world of business and finance, the details are where you find the real story.